Where do you want me to start here?
I'll introduce us. There won't be anyone on, but then people will start popping in, and then they can all ask questions. So I'll pick some relevant questions at the end to discuss.
Where do you want me to start here?
I'll introduce us. There won't be anyone on, but hang on one sec. Popping in, and then they can all ask questions. Okay. Let's see. Good. Oh, I got you right here. You there, Chris?
Yep, I'm here.
Awesome. Hey, everyone. Thank you for joining us. My name is Garrett Goggin, editor, Silver Stock Analyst. Today we have Chris Ritchie, VP, SilverCrest Metals. Hey, Chris, thanks for joining us.
Thanks for having me. Appreciate it.
Yeah, it's no problem. I just want to send out this link to the live stream as no one is on it yet. And then once we do that, let's talk about your drill results and upcoming feasibility. Yeah, here we go.
Perfect.
We'll give it a couple seconds here. But one of the things that has impressed me about your company is you constantly raise the bar. You've had great drill results from day one, and they keep getting better. It's world-class intercepts. I haven't seen anything like this in the silver industry.
We've been very lucky, but it's also at the same time it's a lot of work. In that with Santa Elena, the things that the team learned really translated well to Las Chispas, and Las Chispas was a previous producing asset. So again, there was a lot of upside that was laid out for us with existing stockpiles and access points and journals and diaries and technical reports. So now we're just really dialing in, and we know the asset well. I mean, you can see in the slide here, the drilling leverage, we've hit about 40% of our drill holes above 350 grams a ton. And we use that 350 gram a ton range because if you had an average grade in that area, that probably puts you top 20 highest grade silver mines in the world. So yeah, we're hitting very, very efficiently with that drill bit. So again, right now we've spent maybe about $85 million US since the start of the company on drilling. And a big part of the program is going to be even when we're moving towards production. So for 2021, 2022, we hope to have anywhere between $50 and $70 million available for drilling. So it's not just moving towards that re-rate, it's making sure we have enough capital to really go after more of these really high grade areas that can really drive value to the front end of the mine life.
And if you look at the amount of capital you spent for the amount of ounces that you got, you're finding ounces at what, like 25 cents an ounce or something?
Yeah, I mean, we'll see what the actual feasibility comes out with, but we've been guiding people into the 85 to 95 million reserve ounce sort of zone there, and about 120 to 130 million resource ounces inclusive of the reserves. So if you kind of pick a midpoint in there, you're maybe roughly 100 million ounces and you spent 85 million. So if you can find an ounce for 85 cents, take it out of the ground for roughly $5, which is what our PEA outlined a year and a half ago. And at today's silver prices have about $19 of margin. You're getting a sense of how that drilling effectiveness has really translated into capital efficiency.
Right, no doubt. You mentioned Las Chispas was a past producer, but when did they stop production? Like early 1900s or something?
Yeah, you got it. 1880 to 1930 or so, with Mexican Revolution and problems down there. It sat in a family dispute for a long time. And again, Eric, our CEO, we've been in the community for 15 years, so he knows the people. He's a rancher. It's a big ranching community. We have our own cattle ranch. You have to come down, Garrett.
Yeah.
So I mean, he just knows the people, and I mean that also translated well to a new asset we just bought recently as well. So I mean, yeah, this one still has a lot of legs, and we're just getting started on the other asset.
So I'm kind of, I'm interested in the old prior workings. Are they like how many meters wide are they? Is that where you're doing a lot of the exploration from? Underneath, and is that where the production ore is going to be coming from?
Yeah, there was two existing access points when we went on site. One was in the Las Chispas area, one was in the Bobby Canora area. And there was a lot of old shafts and dumps that really gave us a lot of knowledge as to where to drill. So, I mean, if you found a shaft and a dump, and then 100 meters away, you found another one, and another couple hundred meters away, you found another one, you pretty much knew where the vein was. So again, we have a lot of indications that give us that sort of direction as to where to be spending money, and we still have a lot of those to run with. So we're not out of those opportunities. And then the veins that we have found, there's still a lot of strike length along those veins that we're going to be focused on. So it's pretty rare to have an asset develop this quickly in this short a period of time. So to give you an example, like 2016 was our first full year. We only had one drill rig, right? And that, May 2019 PEA, that not a lot of work went into that. I mean, a lot of work went into it, but, from a mining perspective, not a lot. So again, we're still in the early days of drilling this property off.
All right. It's just, you keep on finding so many high grade areas, and you have veins all over the place. Show me one of those slides with some of the veins, because I'm interested in, the high grade hits, how are you going to mine it and where the ore is going to be coming from.
So here are the two distinct parts of the property. On the sort of upper left-hand side, I would say that's the Las Chispas area. In the sort of to the right hand of the page, the busy looking area, that's the Bobby Canora area. That's the meat and potatoes of the current mine plan. We're really excited about the Las Chispas area, but it's not going to fit into the first 5-6 years of the mine plan. So we're still focused on this area in terms of, again, capital efficiency. So if you look,
why? Because it's slightly lower grade. It's like 500 grams a ton, right?
No, we've got some areas there that are multi-kilo as well.
Oh, okay.
But just logistically speaking, everything in the Bobby Canora area is so close together. The access points allow for a lot of efficiency. So to give you an example, right in the middle of the sort of right-hand side, you can see the Bobby Canora vein. That again contains the biggest amount of the resources that will be the backbone of the production profile. You can see the black line running sort of bottom to top there. That's the access point to come in here. These veins are roughly 150 meters apart. So to give you an example, if you were drilling underground to access the Bobby Canora area, to access another vein 150 meters away might take you about 2-3 months. Right. So again, we're talking less than $1 million of capital just to drift the underground development over there to be able to access those additional veins. So for us, we have fairly narrow veins that are really, really high grade. So in order to fill a mill that is roughly 1,250 tons a day, we need several of these veins to be delivering ore to the mill on a daily basis. So the proximity of these veins is critical, and that's why it's the main area of focus. So Bobby Canora is, in the upper part of that right-hand side. I mean, that's a vein that will be in a reserve, but some of the uncut, undiluted news releases we've had on that vein are, over 3 kilos. I would say that's probably, in the average range. And to remind you, the average grade back when it produced from 1880 to 1930 was approximately 3 kilos.
Wow. And let me just interject for 1 sec. The average silver mine, the grade for the average silver mine across the industry, it's about 200 grams a ton. SilverCrest grades are well over 1,000 grams a ton. Grade is the number one thing that is correlated with profitability. It's correlated with low cost, which leads into, high profitability. So, the higher grade ore that you can get, the more ounces you're going to be getting out of it, the more profits you're going to be making. So, grade is one of the number one things that I look for in, attractive silver mining projects. Well,
to give you, just to stay on that theme, Garrett. So in between that Bobby Canora vein and the Bobby Canora Norte vein, you can see a red line in there, and the writing's kind of small, but that's Bobby Vista vein. That's a new discovery we've made a few months ago. This is a vein that's probably going to be north of 2 kilos cut and diluted in the reserve and resource report. And this morning, we just put out a new piece of news and it was a splay that came off of this Bobby Vista vein. And the headline hole was, I think, roughly 2.5 meters at 61 kilos per ton. That was the record hole, the highest record hole we've had on site to date. So again, we're not running out of opportunities here. The average grade for all of the holes was 9 kilos. But if you take out the big juicy hole in there and to find an average, the average is 2 kilos. So just to refresh people, in the mine profile for the first 4 years within the PEA, the average grade is 1 kilo. That kind of gave us the cost profile and the margin potential. Now, adding up enough tonnage to fill the mill with 2 kilo material, we definitely don't have enough to do that on a consistent basis. But if 5, 10, 15%, you're continuing to optimize with new discoveries, and you're, pushing in the high grade first, and you're some of the lower grade material moving out to later years in the mine life, you get a sense of how you can continually optimize and hopefully up that production profile. So again, in that PEA, we were roughly 14 million ounces a year for 4 years. But since that time, we've made a lot of much higher grade discoveries there. So see how it translates into that feasibility study. But the irony already is that this splay material will not be in the upcoming feasibility study, right? It'll be included in the resources, but not in the reserves and not in the mine plan. So
with your new reserves and resources coming out, in your reserves, a lot of the lower grade of 300, 400 is going to be replaced by 1,000+ gram a ton material, right?
Yeah, in the PEA, we had a cutoff grade of 150 grams per ton, and we've shifted that cutoff grade higher. So that means some of those low grade tons and ounces will be excluded. It doesn't mean they're not available to be mined if they show that they are economic to be mined, but they are going to be excluded in this study. And then that means the higher grade ounces and tons that we find are going to have a greater impact on the average grade. So there's a reasonable chance that you'll see the grades inch up because of that, not just to do with the cutoff grade, but also because the new discoveries we found since that time are higher grade.
Okay. Now, most of the discoveries that you've been finding over the past few months, what depth are they at?
Most of these are still pretty close within surface. I mean, you're 300-400 meters. The deeper zone, and I'm not saying deep zone, I'm saying deeper, that we found with El Muerto about 2 weeks ago, that was about 100 or 200 meters below the existing areas we were accessing. So again, from an infrastructure standpoint, if that particular area just continues to show potential, doesn't cost us much to drift over a couple 100 meters to access those tons. I mean, if it was 2 kilometers deeper or a totally different part of the property, you have to consider all the additional infrastructure you'd have to build out to access it. And that costs money, and that digs into your margins, and it takes time.
That news release a couple weeks ago impressed me more. Like your news release today was amazing and outstanding, but the thing that impressed me more was the one 2 weeks ago, because it's starting to go a little bit deeper. This ore body continues deeper, the width could get wider, it could be easier to mine. Do you have any thoughts thoughts regarding the potential, like how to model the ore body? Like, is there any signaling to any sort of source of the mineralization?
Yeah, I mean, I'll back up and I'll stay high level. Eric and Rosie, discovered Santa Elena and took that all the way from a $4 or $5 million property to a producing asset, with close to 100 million ounces. They took the same geological interpretation and they're applying it here. And that's a big part of the success, on top of A, just their skill, and B, just the historic drilling that sort of led us to water. The deeper zone did apply over at Santa Elena. It's just so far we've had so many targets that were close to surface. It just wasn't efficient use of capital to go deeper at the time. So we're starting to poke around at depth. So that, again, that big vein you'll see in the middle of the Bobby Canora vein, the deeper zone El Muerto is off to sort of the left-hand side there of the extension. but it is, think of a layer cake. It's just literally an additional layer that is beneath that zone. Now, take this all with a grain of salt and forward cautionary statements and all the above. There is a chance that deeper horizon or layer could persist across the other veins in the area. So when you see Bobby Canora Norte, Bobby Vista, the main Bobby Canora, Bobby Sur, Amethyst, and whatnot, there is an opportunity for that other horizon to exist there. So we've just tapped into the first portion of that horizon. It's early days, lots of risk. But if that were to apply to some or all of those veins, it just gives you a sense of that blue sky potential that could exist if we could just sort of double the opportunity set,
Right.
for the vein profile there. So again, you'll see in the bottom left, it's 21 of 43 veins have been drilled. Will be in the feasibility study. I think we're ready to say 45 veins now. So we've kind of upped that a little bit. So when you think about drilling another, and see if we have it here for you. And it's just basically showing sort of the drilling potential here. If you look at the third bullet point here, it's the Bobby Vista vein. Again, this is a vein we discovered after that original economic study in May of 19. That's the one that we referenced that could be north of 2 kilos on a cut and diluted basis in the next study. We've only drilled 800 meters of 2 kilometers. So when you're just kind of continue to push along a successfully drilled off vein, it's lower risk than just wildcat drilling a brand new area.
Right.
So, I mean, that's going to be the focus. Those extra 1.2 kilometers, that's going to be the focus for the next, 6 to 9 months.
Yeah. Regarding the mining of all these veins, how many veins is it going to take to fill your 1.25K mill? And how many faces on each vein will it take?
Yeah, we haven't seen the mine plan yet, but you're certainly hitting on an important point that, again, with the like some of the veins might only be contributing like 100 to 200 tons per day, right? So again, one of the big factors from risk management here is that how early did we start the underground development in order to have enough of these veins ready to consistently deliver that tonnage? So again, we've been underground for probably close to 11 or 12 months now. And that, the drilling and development has been probably within, 3 to 5% of our monthly budget in terms of getting that ready. So when you think we hope to be in production in the back half of 2022, it's still another 18 months or so of underground development to build up a really nice buffer to ensure that we do have enough working faces so that we can consistently deliver that throughput rate. Now, part of that advantage is that as we find new veins, new high grade, you get a sense that, oh, okay, here's Bobby Vista or Bobby Vista Splay or something that we might want to put in there. Again, it might only be 50,000 tons a day or 100,000 tons, but if the grade is significantly higher, you're just going to continually be able to inch up that production profile, hopefully.
How come, Santa Elena started with the open pit there? How come you didn't look at that for Las Chispas? It seems like your grade is so amazing. You have all these veins all over the place.
Narrow vein. I mean, we would love an open pit, because what do you get with open pit? You get a lot of tonnage. So there just wasn't an open pit target we found at this property. I mean, Picacho is the new asset that we just purchased recently. We think there are open pit targets there.
Okay.
And that really would do a lot for us in terms of throughput expansion potential or just adding mine life. And again, because those would be different stopes or working faces or just a different pit, depending on how we would do it. So for us, we've already permitted our facility to be up to 3,000 tons per day.
Yeah.
Again, you referenced the mill size that we're building is 1,250.
Yeah.
We don't have the tonnage to remotely go much more than the 1,250 right now. But again, even if we found 2 million tons at Picacho, if you do the quick math on that, that would be 10 years at 500 tons per day.
Yeah.
So if you could go from 1,250 tons a day to 1,750, again, who knows what kind of grade those tons might or might not carry.
Okay.
It gives you a sense that, trucking that ore down the road into our current facility That's not a lot of cost. We have built or we're in the process of designing the mill to be scaled to 1750 or 2000 with very minimal amount of capital. So again, we just need some time, and hopefully the drill bit keeps going. But it will be the same geological interpretation that we learned from Santa Elena that we are learning from Las Chispas.
And how big is Santa Elena mill?
Pardon me?
How big is the Santa Elena mill?
Santa Elena mill was 3,000 tons a day.
Okay.
And as you referenced, started with an open pit and then went deeper and found some underground material. And today they run it as reprocessing that leach pad, the spent leach pad, for half of their throughput, and then they use fresh ore for the other half. So again, it gives you a sense too that Eric didn't build it out of the gates to max capacity. He built it to get it going quickly in a capital efficient manner.
Yeah.
Look to expand, which again is the same thing we're looking to do here. We just need some more time.
Yeah, it's smart, bootstrapping it a little bit instead of sandbagging all the shareholders by, issuing endless equity.
Yeah. Well, that one had about approximately 20 million of capital and had about a 6-month payback.
Yeah.
For us, we'll need some more capital. But if you think about it, at the end of the day, our market cap today is roughly 1.3 billion US. We've spent about 140 million, and we have about 135 million now. So if you subtract, those two figures from today's market cap and divide it by the dollars we've spent to date, the roughly 135, we've added around $8 or $9 of value for every dollar that we've spent.
Right.
So it gives you a flavor for if that drilling can even keep moderately close to what we've done so far through that build phase, that you're not only working towards cash flow and a re-rate that traditionally comes with production, but hopefully you're going to be picking up an optimized mine plan, a new asset that might or might not take shape, and just hopefully more ounces and tons at Las Chispas with all the veins we haven't touched yet.
Right. What's your budget in 2021 looking like, split from exploration to development?
Sure. So I think, the total amount of capital we would need above and beyond the cash we have in hand today, at the end of the year, that's an important distinction. So we think we need approximately about $160 million US, and that will cover CapEx, minimum cash balance, working capital, G&A, like all the proper buffers that you'd want to have through a construction period, with an aggressive drill budget. So again, we haven't seen the final numbers come out from the CapEx yet, but these are sort of the numbers we're kind of working with as we know them today. If we had $40 million US to drill in 2021, that would be a very aggressive drill program. And again, I'll reference, on the bottom right of the page here, if you look at it, depending on your ounces, you're 70 cents to $1 a finding cost per ounce. So it just depends on how economic those ounces are. So if you're finding 30, 40, 50 million ounces, are they really, really high grade that we're going to put in the front end? Are they lower grade? We're just adding to the mine life. But either way, we're hoping that those dollars can really translate into value.
Why are you drilling at all in 2021? It's like your results have been so spectacular and off the charts. It's like, how can you do better? You're going to have 100 million ounces already. Why not just spend it all in development?
Well, right now, when you talk about, adding $8, $9 of value for every dollar we've spent, I mean, it's highly accretive. So again, as per the PEA, and I'll just reference this number because it's a good place to start until we have more updated numbers. If you look in the middle column there, shows the first 4 years of production based on the old economic study. And you'll see the second row down says average grade in the gram per ton. That's 1,000 grams per ton silver equivalent. And again, if you scroll down a little bit from there, you'll see the average production profile. Just under 14 million ounces a year at $5. But that's an after-tax free cash flow of 135 million. But that's at $19 silver and $14.50 gold. So again, if you were to use $25 silver and 14 million ounces, that's $20 a margin. So you could sort of argue, as per these, without considering the discounting for time and whatnot, every 14 million ounces at a kilo we find, could be translating into, $20 of margin. So that, you're looking at, 280-ish million pre-tax. So if you can find, 200 million or something like that, or 150 to 200 million to the NPV for every 14 million ounces or so, that moves the bar really fast in terms of your valuation. So we'd like to say tongue in cheek that we'd like to be able to drill ourselves cheap. And if we can continue to find those ounces, add to the mine life, hopefully even inch up the average grade profile, and maybe you were getting, 15 or 16 million ounces a year.
Yeah.
That's the priority. And then again, on top of that, if Picacho has any tons or ounces to add to the equation, I mean, maybe the production profile alone can shift higher just on increased throughput.
How much are you spending on or drilling in Picacho in 2021?
We haven't sort of come out with that plan yet. We're still doing the workings, sort of the preliminary work on that. We have looked at it for 4 years. We know it very well. So we'll see. We'll be talking about that when it's appropriate for us to get on site. But that would be a nice little cherry on top for additional drilling. It does have a historic resource on it. So for us to come out and just twin those holes or try to duplicate the work that was done, there might be the potential for some low-hanging fruit ounces to add to our resources.
Right. Okay, that sounds good. That's a pretty good update. Is there anything else you want to highlight that we really haven't touched on yet?
Maybe the defense as well. I mean, we're seeing 2 vaccine pieces of news in the last few weeks. People are wondering if 2021 can keep up with 2020. I mean, just one thing to highlight for people is that given that potential cost structure, if gold and silver do not perform well and they go much lower, you can see in the top left of this page, we would still have 135 million of free cash flow as per the PEA. At $19 silver and $14.50 gold. Well, again, our market cap today is similar to about 1.3 billion. So, that's roughly almost a 10% free cash flow yield if gold and silver take a pretty healthy hit.
Right.
And I think that's worth noting. If people aren't really sure if it's going to go down or up, we do much better than most of our peers at lower gold and silver prices.
Yeah.
At the same time, if gold and silver go higher, we're going to participate. And our drill bit
your margins
is going to also add, outpace most in terms of the growth profile.
Right. Yeah. Your margins are so much greater than the rest of the industry. Your margins will go from 80% to 70% if the silver price, goes down, which we don't anticipate it will. But, there's a lot of silver miners out there that operate and they don't make any money. And when they don't make any money, the management has to be paid somewhere, and, who pays for it? The shareholders. It's just constant dilution. The share price goes down. So, we avoid companies like this. We look for companies like, SilverCrest Metals that has extreme high grade, leads in very low cash costs, very high margins, and you don't have to worry about dilution.
Everyone on the management team has over 80% of their net worth in the company, so we're all on the same team.
Yeah, and that too. How much does management own of the company?
If we have a slide in here, personally, I've bought 600. I mean, there's slide. I've bought 650,000 shares.
Yeah.
As a team, we've purchased over 6 million shares. So those dotted red lines there are sort of an industry standards or a governance-based standard on what the appropriate amount of stock that should be purchased by management relative to their salaries. So they usually like to see somewhere between 2 to 3 times the amount of your annual compensation have been purchased by the management team.
This slide's it's a little confusing. I looked at it a few times and I didn't understand until you described that to me.
So you can see for say Rosie, she's there, and so the red line is roughly where the 3 times her salary would be, but she has purchased 22 times the amount of stock as per
22
a traditional governance requirement. So you can see that
what's a dollar value?
we're healthy shareholders.
Yeah. What's a dollar value? She a millionaire yet?
Oh, she's a millionaire. I mean,
Yeah, all right.
yeah, well, if you know, across the team, we've purchased over 6 million shares between us.
Okay.
You know, so US, that would be 60 million US dollars between us that we've purchased with our own money.
Oh, wow.
That's not including options.
Yep.
Shares mean more than options, but in terms of overall exposure to the company, it gives you a sense of why we work nights and weekends.
Yeah, hell yeah, 8% of the company, and you know, a lot of the companies I follow, the ones that are dilutive, the management, they own 0 shares of stock, and all they care about is getting paid their salary. They don't care what the share price does. They run at a deficit. They dilute shareholders. The share price goes down. They don't care. They still get paid. And there's a lot of companies in the industry that are like that. And this slide is very important because SilverCrest Metals owns 8% of the company, and they believe in it, and they're aligned with shareholders. They're working hard to generate value. They make money when the share price goes up. They lose money when the share price goes down, as does a shareholder like you and me. So
And,
you know,
and it's interesting too, because we'll be commercial, right? At the end of the day, we don't necessarily need to hold on to our jobs for the salary. If it's the right thing to do is to merge with someone or sell the company, we're going to make the right decisions. We're not trying to protect our salaries and try to hold on to our jobs for long periods of time.
Yeah, and that too, you see some crazy deals that benefit managers, but shareholders don't make out, they get screwed. So yeah, it's good to see that you're aligned with shareholders. We like that. Okay, that's great. I appreciate the update. I think we covered a lot of information. Your feasibility is coming out, what, December next month or January?
Yeah, next month or early Jan. It's just around Christmas time. It's a bit tricky, so it just depends on when we get it done, and we'll have to release it. It's a material document, so just kind of fiddling with that. But it's probably mid-December or early January.
Okay.
We're also going to be probably putting out some more drilling news between now and then.
Okay.
We hope to have more details to provide around the engineering and construction contract that we will hopefully be working towards.
Okay.
And then we're also working on a potential debt facility. I'm not sure if and when that comes to fruition, but that could be something in the next few months.
Right.
So we're going to be busy. And then behind that, we're again, like the drilling will be ongoing.
Yeah, but that debt facility, it was 160 mil. Some of that's going to be equity, and you're going to get a large chunk of it being the debt facility.
Yep.
But you basically you can pay that off in 1 year.
I mean, if we were to borrow 100 million, and again, I'll go back, we looked at $19 silver and $14.50 gold. If we borrowed 100 million, we'd still be paying it back less than a year, using that PEA production profile. So yeah, we don't want to get too cheeky and too cute. If we were to raise 60 to 80 million of equity, we've got 129 million shares outstanding as well. So from a dilution standpoint, you're in the 5 to 7% range. So again, our capital structure is not sensitive to these things. So again, risk management is a huge priority, and making sure we've got enough capital to continue to push forward and add value.
Yeah, good. That sounds good to me. We love the story. There are a couple questions by people watching, but you basically answered them all as we talked about everything. So I think we covered all the bases. So thank you all for joining us. Thank you, Chris Ritchie, for joining us and sharing information about SilverCrest Metals. It's an exciting time over the next year as you move into development and hopefully production in 2022. So we're going to be following you closely.
I appreciate it. Thanks so much for your time.
Awesome. Thanks, Chris. We'll see you.
Thank you. Cheers.